righty, everyone. Well, thank you so much for joining Miguel and I. So what we're going to be talking about are going to be a couple of hot topics, some changes from 2023 to 2024. Miguel and I want to keep it a little bit more conversational than usual, just the typical, hey, webinar, we go through some slides. So we're going to try to play off each other a little bit and keep it entertaining for you guys. So without further ado, it's always just nice to know who we are, what we do day in and day out for clients. So with that, of course, we're going to go through our agenda. We're going to go over some crucial tax law changes, what to consider for 2024. Adjustments, FinCEN, there's some really cool updates, some top priorities we want to key in on. And then, of course, at the very end, we'll just host our Q&A. So feel free to, as we go along, if questions pop up, feel free to throw them in the chat and we'll address them at the very end. All righty then. So interesting fact of the day. Miguel, why don't you kind of fill us in here a little bit?
Tax returns are already getting filed. So we'll talk a little bit about, there's a lot of, I think, noise in the news about should I wait to file? Congress has a bill on their desk that they may not pass. And we can talk about how confident we are in what Congress is doing later. But for now, there are still people who are filing their tax return. As of last week's data, 53 million tax returns filed.
That's pretty crazy. That's very surprising. I mean, personally, don't kick me while I'm down. I haven't filed my taxes yet.
Oh yeah, no, tax people never file their taxes until they're done with their clients. So welcome to the club. Yeah, 36 million in refunds. I think our deficit's in the trillions. So I think that's just a penny for the Treasury. I don't think it's not like if you guys remember the ERC days or the PPP loan days, like this money doesn't run out, guys, right? This is part of the federal budget. So yeah, just know that tax returns are already being filed. I think a lot of people are extending. We typically in our business see a lot of extensions. So I think we're seeing even more extension. Like these just sound like big numbers. I still think like there's always the same like 80 million people that filed at the beginning of the year who were like simple W-2s. I don't know, 350 million people in this country. Like, don't get FOMO, guys, but just know that the tax return is already being processed and accepted. Average refund up slightly, 3,000 this year. Okay, and we'll talk a little bit about how that might change if Congress passes this new child tax credit.
Yeah, I wonder if that's due to any inflation or anything like that as well. Could be. But yeah, let's run through who we are. Just if you guys haven't met us, it's always a pleasure. Just introduction. My name's Jacob, of course. This is Miguel. I'm an account executive with our firm. Miguel's our managing partner, of course. But really what we want to do, driving message wise at Shared Economy, our philosophy is providing you guys strategic planning advice throughout the course of the year. I do feel like when you work with, an H&R Block TurboTax, you tend not to receive as much value as you would if you were getting strategic planning throughout the current year, right? So things that you do that are going to impact your 2024 tax returns start January 1st. So we want to be an educational resource for you guys such as this. We want to provide webinars for clients. If you're not a client yet, of course, we want you to receive that value as well. So education is very big for us. And then also we want to make sure that we give you time back. Time's finite. We never do get it back once it's said and done. So we want you to spend, your time in other facets of your life, whether it's spending time with your family, your friends, or, on the creative side, driving your business and growing it. Leave the boring stuff to us. We'll make sure that you're taken care of throughout the year. And we'll, of course, usually address past taxes, but really what we want to do is look forward, not backwards, always. We want to get you caught up and concurrent. Some of our accomplishments, not going to go over every single tile, but feel free to read through it. I would say one of the biggest core capabilities that we like to focus on is going to be on the accounting side. So think bookkeeping systems. If you haven't already, absolutely look into one. We're partnered up with an accounting software called Xero. But we do support other ones. QuickBook Online is another big player, of course, with Intuit. So all of our accounting staff is QuickBook and Xero certified. Should you need any help with the accounting, your bookkeeping systems, whether it's starting from scratch, taking it over because it's a bandwidth issue, or just simply being a reviewer and running diagnostics throughout the year, we do have different services that do take care of all the above. A lot of our clients are first-time business owners. They're not really sure if, hey, does it make sense for me to have an entity, an LLC, for example? A lot of our clients, of course, do you have a spouse? Should I have a partnership amongst my spouse? Should we just be a single member LLC? Those are all great questions, and it does range depending on your long-term, short-term goals, of course. So seek an advisor, make sure that you do get that guidance from a professional. Don't rely on Google.
But enough about us. Let's talk about.
Our areas of expertise. No, this slide's not meant to look overwhelming, but really it's just some call outs on what we do day in and day out. Miguel's jumping the gun, getting a little excited, but we're gonna start diving into more topics. But really, breaking up our approach on tax and accounting, you can see that, for example, depreciation we'll discuss a little bit in depth later, bonus depreciation specifically. But making sure that all of your compliance is going to be, handled by us, right? Make sure that you do find other resources should you not become a client, but we want you to, of course, find value in today's webinar. Here's some of the team members.
Enough about us.
Enough about us. Okay.
No, but
this is who you're going to work with. Should you become a client? If you're already a client, hopefully these names and faces are familiar to you. So starting left to right, just a couple of highlights. Carla, she just had her baby, by the way. So should you reach out to her, make sure you congratulate her.
Oh yeah, actually, for clients watching this, if you got an email from Carla saying she's on mat leave and Mike will file your return. If you want to keep working with Carla, let us know. We're just trying to accommodate being short-staffed. So Mike here is our head of tax, the most senior tax advisor we have on the team. He is leaning in to cover for Carla. So I think we sent an email that basically said, like permanent transition. I think it was just kind of worded not the best way. So yeah, if you're a Carla legacy client, I just say this because clients love working with
Of course,
Carla.
yeah, absolutely.
She's been with us since like 2016, 2017. She's coming back.
Yeah.
We were just baby came early. We were just on it to try and get it. So yeah, if you are a Carla legacy client though, and I think we've communicated this out, like we have a lot of folks that are getting extended, so that we got more time to file. So
exactly,
we are making sure we get those tax projections in. So I think, I just want to be conscious of this early on in the webinar. I know we're going to cover it, but hey, April 15th is not far away. The business deadline is Friday. Extensions are not a bad thing. I think most high net worth individual shops, what I mean is tax practices, like 100% of their clients are on extension. I get that might not be ideal. I think, from our perspective, we are experts. We don't want to file a return that we can't sit in front of a banker or the IRS on. So yeah, please afford us a little grace there. We want to get it right. And Congress might change the rules. I'm gonna hold it there. But anyway, hey, this is us.
Yep.
Most important person on this slide deck. You know who it is?
It's definitely Mike. No, I mean, I think Miguel might be giving me a little shout out there, but yeah. So should you guys ever need anything from me, whether it's if you are a current client, I'm sure that we've spoken in the past. I'm always here to advocate for you. So if you have any questions for me, feel free to reach out. Thank you for your slack during busy season. I know I'm not as tentative as I could be, but I'm always trying to take the best care of you as best as I personally can. So yeah, we can move ahead here. All right. So what are the top tax changes for 24? There have been a couple of hot topics. So Miguel, I know that there's a couple of things that we're going to discuss here. I think that one of the really cool ones that a lot of people might not even be considering is going to be that child tax credit. I personally, I'm not a tax professional, as you guys do know. Why don't you tell me a little bit about what the child tax credit is and, why is it important? Should our clients be doing it if they do have kids?
Yeah. Having 3 kids, I think this one's important. Key things, it does phase out at a certain AGI. I think it's $200K if you're single, $400 if you're married, but you can still get some of it. So even if you're in a higher tax bracket, it's not going to be the credit. That's why you have business and tax advisors like ourselves. They'll give you a strategy where you can really make an impact. But it is something that I think a lot of people care about because historically it's been so high. So, it used to be, I think it was 4,000 for a while. That was a special thing that we got during COVID, now it's come down to $1,600 refundable,
Mhm.
$2,000 per qualifying child under 17.
Gotcha.
So, we do all this work for our kids. I have 3 kids. What do we get for it? Lots of thanks and good behavior? No, but you do get a little bit of a tax credit. And the bill in Congress right now, it's stuck in Senate, has it up to, hold your horses, is this going to be good? 1,800 refundable.
Mhm.
So like we're talking about $200 difference. But I will share, I think, there's a lot, I think the news is blowing it up, and we did a post on it and we're adding it here because it's trending on Google. So like user intent is all curious about child tax credit.
Mhm.
It's $200, and the IRS has said you don't need to refile if they change the rules for this one. They will automatically update your tax return. So
Okay.
if you were thinking about holding on for those 200, and hey, maybe you have 3 kids like I do, so it's like
Mhm.
$600, it pays for the tax
Sure.
return, if you will. You don't need to hold on to it.
Gotcha.
You'll get that adjusted. There's other things that might change that actually will have a material change where you will have to file an amendment. So I want to spend time talking about that. But child tax credit, if you got kids, look at it. Not much there though.
Yeah, absolutely. Yeah, and funny enough, I think it's always good to get some real world experience. So definitely take advantage of that child labor. Alrighty then, section 174. So Miguel, why don't you give us a little bit of insight too on the changes in section 174? What does it mean for us moving forward in 24, 25 in the future?
Yeah, so this is one that is more important for our startup segment. We do have a segment of our business that's completely focused on tech startups, but essentially 174 concerns the expense treatment of research and development expenses. So to the extent that you have any development of intangibles within your business, you no longer get to expense those costs. You have to amortize them. So essentially, you have to depreciate salary costs.
Interesting.
Yeah. So the word for depreciating an intangible asset or salaries, like it's not an actual thing, is amortization. So to boil it down, you used to, if you're a startup and you made 100,000 in revenue, but you have 100,000 in development costs, historically you've broken even. You don't have a tax bill.
Right.
And that makes sense to a lot of startups. They're like, hey, we're not revenue positive yet. What happened with Section 174 is this was the rule pre-Bush era. So for the last, 20 years, like 2001 dot-com bubble bust to now, Congress has agreed it's a pretty good idea to incentivize startups to, hire people even though they're not revenue positive. So let's give them expense treatment, meaning you don't have to divide it by 5.
Right.
Now they've allowed this to expire. No one thought it was going to expire. We even have connections in the kind of the Big Four world where they didn't tell their clients to prepare for it because they fully expected a rational, collaborating, forward-thinking Congress to rewrite this rule. Well, they let it expire. So what hit last year for a lot of startups is that they all of a sudden had a tax bill because in that example, 100 income, 100 expenses. Now that 100 has to get divided by 5.
Oh, wow.
So you only have 20. So now they've got 80 of taxable income when they don't have cash, right? They're also having this issue where VCs aren't shelling out money the way they used to. I think that's starting to come back. But it essentially created this tax liability to businesses that aren't doing that well.
Right.
So even if you don't believe in helping big tech, 174 is one that's supposed to be included in this bill that corrects it for the small business, for the small startup, and these are places that like that 100K, in a small startup might be $1 million.
Sure.
These are 10 to 15 people that
Right.
rely on this check to pay their business. And now the company itself is shorter on cash, has a shorter runway.
Gotcha.
Yeah.
So how would that impact our clients? Should they be concerned?
I don't think it does. I think this is a part of the category of additional tax information makes you a smarter, better investor. I think to the extent that you do invest in small funds or, there's a special tax code for people that want to hand a check over to a small business because we do encourage, friends, and a lot of our on the tech side, a lot of our clients will do friends and family rounds. So, our clients are all investors. So to the extent that you have someone in your network asking for a check, this is great information to pass on. But yeah, certainly I think if you believe in the small startup, again, I'm not a PE or a VC guy, but if you believe in these companies that are able to start from nothing and actually create like a valuable revenue generating business, I mean, this is something that definitely hurts them.
Gotcha.
Yeah.
All right, some energy credits. So if you guys have those nice Tesla solar panels, maybe this applies to you. Miguel, do you think it's a viable option? Do you think that it's worth getting that credit to go ahead and get some solar put in?
Well, I mean, I think that depends. It really is a cash question, I think, because you're going to be out more cash than you get back. The government isn't going to pay for your solar installation, but you'll get some percentage of it back. It's 30% right now, and it is up to, there is a cap on it, but there's two kinds of improvements we should look at. One is solar, which I just explained. The other one is home improvements. So that's where that's a lower limit, but that's where you're replacing. I think I've listed it here.
Sure.
If you're making anything on that list more efficient, from an exterior door to your stoves to your HVAC, even getting a home energy audit, which I think is a good business model now. I mean, if I was 17, I've got a kid who's 17 looking for a job. It's like, hey, find a checklist from ChatGPT and go knock on people's doors and tell them that they can get a home energy audit where we recommend products and give them, and they get a 20 to 30% tax credit for claiming that. And then we're basically giving them the roadmap and maybe the affiliate links on Amazon to go purchase those things. I would definitely do that. But yeah, we can provide more information. I mean, we're gonna have to cover things really quick. But yeah, 20 to 30% on solar and home improvements. Something that, I think a lot of our clients are thinking about doing now.
Gotcha. All righty, bonus depreciation, hot topic. So personally, if you guys have hopped on a call with me, you know that I talk to death about the bonus depreciation. There's a couple ways how to claim that. Specifically for our Turo clients, for example, we can look into Section 179 bonus depreciation. Exciting news. I don't know if you joined our last webinar, but we're keeping our fingers crossed that Congress is going to pass and bring it back into full effect. Hopefully that's going to be the case. Right now, where we're slated in 2024, it's 60% of that 100% purchase price. So it's still worth it. It's not 100. It does kind of suck, but it is what it is. For our real estate clients, you're doing short-term rentals, long-term rentals, specifically short-term. Bonus depreciation with the cost segregation study can provide you thousands and thousands of dollars instead of taking it over 27 and a half years. You can expedite that, of course, over the course of 5. So there's a couple different ways. Miguel, what do you think is the most, I would say, common option for bonus depreciation in retrospect, or in regards to both of the industries that we do service? Both industries, we technically service 1099 in general, but I would say a large portion of our clients are doing real estate, short-term rentals, long-term rentals, run arbitrage, as well as car share. So Turo, Get Around, those types of platforms.
And I mean, we got a fair amount of freelancers. But I think, yeah, this mostly impacts the car share and home share segment, where it used to be that you knew if you bought a car, you could bonus it, right? And some people know the heavy car rule, or if you got a heavy vehicle, you can get 179, get all that deduction. Yeah, that's true. But even if you got a smaller car, the bonus on it was pretty good. So bonus has historically been a good way to know as a consumer that, hey, I'm going to go out there and buy something that, dollar for dollar is going to reduce my business income. This is changing that. And bonus too on like cost seg and home acquisition was great too, because the cash to deduction benefit was leveraged highly. What I mean by that is, if you go back to my example of having something that you spend $100 on, that you only get $20 of the deduction, like that's bad.
Right.
I think net present value, yeah, you still get it over time, so you'll have more deduction next year and so on and so forth, until you're at parity, in year 5, where you've got multiple years. But mostly what we like as tax efficient investors is when the cash outlay is smaller than the tax deduction.
Right.
So does that happen when you purchase a house? So if we just go simple with numbers, if you buy a $300,000 house, and you divide that by 30, you get to, 30,000 would be 10%, right? So you get like 90,000,
right?
Let's just say, right? So or sorry, let's just say you divide it 10 and 3, so you divide it by 30. Point is, let's assume that you get a $30,000 reduction annually.
Mm.
You know, the point is that you're getting far less than, and you put 20% down.
Mm.
You're kind of out of the money from a tax perspective. What bonus allows you to do is basically go out cash that 100 and go out and get like a $200,000 reduction.
Mhm.
So all of a sudden you're extremely tax efficient because you're able to use bonus.
Mhm.
So Congress is kind of starting to think, hey, we got to balance this budget somehow. Let's take it from the taxpayers.
Mhm.
And what that essentially has meant is that they've phased out, you know, when they passed Tax Cuts and Jobs Act, everyone was like, great, like we love this, like we're all getting more refunds. Well, part of that original plan was that a lot of these things sunset out, they get
Mhm.
taken away. What's happening now is we've all gotten used to the rules and we're starting to feel the pain of it going away. Now, you know, if you zoom out and you try to play like what's good for the budget, you know, it's kind of hard to deal with. Like, we're not macroeconomists, we're microeconomists. We're looking at our client's picture and they're like, hey, wait a minute. So what do you mean if I buy something now, I only get 80% of that deduction?
Mhm. Mhm.
That's what's happening. So it's 80% for 2023, the tax return we're filing.
Yes, yes.
And then next year, it's kind of confusing, right? We're in 2024 now. It goes down to 60%. You still get the rest, you just get it later.
Later, exactly.
But now this idea that you had that, hey, I'm going to go buy something for 100,000 and get 100,000 reduction, it's now 80,000.
Yes,
You know?
right.
So like, if these are the rules, then the rational thing to do is to front load purchases you need over the next 2, 3 years,
Mhm.
because you'll get the deduction now instead of waiting. That said, Congress is, you know, dangling a carrot, and they're basically saying, hey, you know what? We want to keep these rules in place. Now, it's being held up right now because some people are also asking, how are we going to pay for it?
Right.
Which is the first time I've seen Congress ask that question. Like, we had COVID, we've had all these wars abroad, you know, like,
But they're getting
no one's
hung up
asking
on
like
this.
how we're gonna, oh, we want to give 200 extra dollars to regular people with children. No, how are we gonna pay for this? But you know, jokes aside, I think it might be significant for you if you did buy something for 100,000, you file it with the rules today, and then the rules change.
Right.
And Congress passes it, because now you've left 20,000 of taxable income on the table that you got
Mhm.
taxed on. And Congress isn't going to, you know, if you forget to report anything, you know, IRS will say, hey, Jacob, you didn't report this $100. I'm going to assume that you have no deductions, so you're going to get taxed on the full amount. But the reverse happens, no, they don't care.
Right.
You know? So it is going to be a process that if you do need to file now, whether you need it for a mortgage, or you know, FAFSA, anything like that, you will, if the rules do change, I mean, the ROI will be there to amend.
Gotcha.
And you can't just fix it. You can't just be like, oh, I'll fix it on 2024. It doesn't work like that. You've got to get 2023 right if bonus depreciation changes.
Interesting.
Yeah.
Yeah, and also kind of piggybacking off that too, there are going to be certain situations where, depending on your long-term, short-term goals, everybody's situation's different. Sometimes it makes sense to, you know, wait on that useful life with the depreciation. So it's not a one-size-fits-all by any stretch of the means. So make sure you consult with an advisor just to make sure that you have the appropriate plan set up for what you're trying to accomplish. All right, some adjustments. So why don't you fill me in a little bit about, some of the changes from, 2023, the tax year that we're currently preparing into right now, how it's going to impact you guys this year, what you should be looking out for.
Yeah, do you want like the dry like black and white number or like
Let's-
my personal reaction?
Let's do both. I want your I want the dry, and then give me what your reaction would be.
Yeah, so you know, it's funny, we've got a financial advisor next door who talks about inflation, and I don't know if you remember, but like a year or two ago, the Fed was like, it's just temporary, like we called it transitory inflation. So like government has this tendency to like ignore inflation, and the IRS tries to keep up every year, you know, and again, talking about going from $1,600 to $1,800 on the child tax credit, it's essentially what's happening with the percentage adjustment. So if you look at the standard deduction jump from like last year to this year, it's like $2,000. Is it keeping up to the 8% that we're feeling like on an annual basis? Like, absolutely not.
Yeah.
So there is some move towards it. I think it's a joke. I mean, I'll give you some examples where I think it's absolutely ridiculous. We all know as business owners, we have to issue 1099s, and I hope you've already done it. If you haven't, reach out to us. It's pretty simple for us to do, but there is a process. where anytime you pay a contractor $600, you have to issue them a 1099.
Correct.
That basically tells the IRS, hey, I'm deducting this from my income, but go chase them for it because they got paid $10,000.
Right.
It's like a W-2 without the withholdings, but you have to do it if you pay how much?
600.
600, right? So guess when guess when that dollar figure came out.
I'm gonna guess that dollar figure came out. I'm gonna say 21.
What year? Of what century?
Oh, this one.
You'd be
Oh.
you'd be closer to saying 1921.
Oh, Jesus.
Yeah.
Okay.
Yeah. So no, not quite the times of Jesus, but almost. So yeah, 1930s, 1940s, this rule set. And like if you adjust it for inflation, like that number would be like $6,000.
Right.
So the onus is on who? You.
Yeah.
You thought you were just setting up turnkey investment with an Airbnb. You just needed a property manager, you just needed a few things. Well, you got tax compliance because Congress can't seem to understand inflation, and the Treasury seems to apply it at the most like minute, discrete scale. So yeah, I think you look at the way things are moving. I mean, standard deduction needs to go up. Child tax credit needs to go up just on the basis of inflation.
Sure.
Like if you look at grocery bills now, again off topic, but like the bet like Congress wants to keep having kids, man. Like
Yeah.
they gotta, if we're worried about Social Security being funded, like you gotta give me a little more credit for making money if
100%.
I've got a kid.
Exactly.
But yeah, I think the limits haven't changed significantly at all. We basically have the same numbers. So yeah, okay, inflation adjustment, but I think it's absolutely way understated for what we're actually experiencing from a consumer, like cut out all the other crap, but like just from a consumer perspective, like price of bread's gone up 30%.
Yeah.
Yet we still have to, if we pay someone $600, goodness forbid we forget to do that.
Right.
You got to get everybody you paid $600 a 1099, and if you don't, it's a $150 to $300 penalty per 1099. It's like, get out of here, guys! Like make that 6,000. That way, like the small ones, you don't have to worry about.
Exactly. Interesting. And that was just more call outs. So we already kind of went over that. I'll pause here if you just want to take a quick gander. Miguel, if you have any last thoughts on this, so we're good.
Yeah, I mean, I think it was like 24K like 3 years ago. So yeah, there's a little bit jump if you look at the standard deduction between married couples. And just remember the importance of this for those that aren't clients or haven't done like higher level tax strategy, just the 101. Standard deduction is what you have to beat in order to get an itemized deduction. So for those of you thinking that every time I write a check to charity, it's a tax deduction, but you're under the standard deduction, you're not doing it for tax reasons. You're doing it to be charitable. I just want to say there are times where you can be charitable and do it for tax reasons. You're just not there if your standard deduction, if your itemized deductions, which is the sum of mortgage interest, local property taxes, and charitable contributions, don't add up to above 29,000 as a married couple. That means that you're just doing charity, which is good on its own.
Gotcha.
Yeah.
Okay, cool. All right, very, very hot topic right here is the Corporate Transparency Act. And there's been a couple changes. What did this get brought up a couple days ago? Was it yesterday, on Monday?
I think it was last week.
Last week?
Yeah.
So yeah, Miguel will give you a little bit more insights, but essentially they're trying to report and help out with cracking down on shell companies. So why don't you give a little bit more context about that?
Yeah, I did a whole webinar.
You joined us, yeah.
Yeah, like a month ago, and everyone was like, I thought we were going to talk about taxes. So I think we had to do a better job of marketing. Like, this is not a tax call, this is FinCEN. So FinCEN, for those of you that do know, this will be a little repetitive, is basically a requirement under the Department of Treasury, under the Crime Enforcement Network, that's what the CEN stands for, to require disclosure of ownership of LLCs. So, for those that had TikTok accounts or Instagram accounts that were like, set up an LLC in Wyoming and you don't have to like report yourself as the owner, like dead, right?
Yeah.
Like kill all your content. I hated it before. I still hate it now, but now it's no longer applicable. Realistically, like I think the best way to do tax strategy is to do it in the light, not in the darkness. And Congress is essentially creating a rule, already did, Congress can't agree on anything, but they agreed on creating this rule that all LLCs must file this official report to get a social security number. People are like, well, wait a minute, like, don't we already have that? Isn't that a tax ID? Yeah, so the issue is that everyone's been filing tax IDs under a very easy process. Congress now wants an official database record with all the owners for entities of a certain size. What's crazy to me is that there's a big business exception.
Mhm.
So your
Of course
publicly
there is.
traded companies, yeah, your companies with 25 employees or more, they don't have to do it. So essentially, this is all on.
Us small guys.
Yeah, so we're gonna create a new rule for everybody to capture these shadow LLC
Mhm.
violators. And the rule, I think the penalties are like 25 to 50K and like you go to jail.
Yeah.
The reason that is more as a tool to lock up, your Al Capones.
Yeah.
Say, hey, you didn't file your BOI. Why? Like, because of course they never were, right?
Mhm.
They can't, right? Versus like trying to take, our client, like Sharon, who lives in Ohio, is 70 years old and does an Airbnb outside of her back house. Like,
Right, yeah.
they're not trying to put her in jail. Yet that's what we're telling her.
Yeah.
Like, you're gonna go to jail if you don't follow us. So there's been a challenge in federal court that basically said FinCEN is unconstitutional.
Mm.
Now everyone's hearing that and saying I don't need to file. That's not the case. Like I'm not a lawyer, I should say that. But I talked to one, and I talked to a few actually, and they basically like if they'd filed like a class action kind of lawsuit like on behalf of an organization that represents small businesses, then maybe it would be more expansive. But right now, the only business that's excluded from filing this is the one in court. The thinking is that this is the first indication, or is the big news, this first indication that the Supreme Court will take this up and, may agree with lower court, may not, right? We remember that from civics in elementary school. Supreme Court will ultimately make a ruling for all the land. But if you're not in that district, and I can't remember where it was, but it doesn't apply to Texas, doesn't apply to California, not a big district. But if you're not in that district, like it's not even close to applying to you. But even if you are in that district, what my legal friends have told me is essentially like, unless you're that business owner, like you're still not exempt. Now, the penalties kick in by, if you don't file by January 1, 2025.
Exactly.
So I don't want our clients thinking they've got a year. I would say we've got 4 to 5 months to see what happens. If the Supreme Court hears it, see how it develops. We were saying that we were going to get them all done Q1. Now we're thinking it's more Q2, Q3. So my recommendation is still plan on doing it. Just, don't rush to do it now, but definitely bookmark it as something that needs to get done before the kids go back to school.
Gotcha. And if they're not following along, we have to be in compliant. We have to have our head in the weeds of all this. What should be a good point for them to mark on their calendar to reach back out to either us or at least check back into it to make sure that it's handled?
Yeah, I'd say summer. So, in our Centurion plans, we have a timeline that we calendar with clients. We try to come back in June and look at how the year's going and project the year out. That's going to be the bookmark for us as a firm to push it back out. Say, hey, okay, it looks like it doesn't look like the Supreme Court is going to give us any indication, and we just don't want to be outside of the rules. We do it, I think, for $300 or something like that. But I mean, you could do it yourself. Like I'm sure there's YouTube that like, you're not gonna go to jail. I can't legally say that, but it's a question of like, are you gonna file or not? The answer is absolutely yes, unless, and I don't know that we want to bet on what the Supreme Court will do or not do, unless the Supreme Court says that it applies to all businesses, the whole country. It's against the Constitution itself to require this. Not a legal expert. Maybe we'll get some on later, but I would say still plan on doing it.
Sure. Yeah. And like Miguel mentioned, we can handle it. You guys can handle it yourself. It's rather simple, but you got to remember that it is, there is a lot on the line, a lot of penalties. There is possibility of jail time. So if you don't feel comfortable doing it, by all means, make sure that you have a professional to do so if you don't handle it yourself. That was kind of the driving message here. Take it seriously. All right, closing thoughts. And then we'll, after we go through some closing thoughts, last little tidbits here, then we'll open it up for Q&A here. All right, Miguel, do you have any last things? I mean, we touched on a couple major points. What would you say your top, 3 takeaways would be of these new changes, what to look out for?
Yeah, I would say bonus depreciation may come back. I will also say that, I think as I look at kind of what our business owners have been saying and doing over the last 2-3 years, it's like we've used this word new normal, right? Like post-COVID. And I think we had like some of this where actually like now we are at a new normal. So I think like our big message to business owners actually isn't as much tax related as it is just planning, which is, hey, what do the next 3 to 5 years look like?
Mhm.
Are you looking to exit out of properties? Do you have a plan to acquire 2, 3 more properties? Are you waiting on interest rates? I think having a 2 to 3 year plan and understanding the tax blips along the way is really where we're at now. Even for, I mean, we've got a lot of clients, like just to share with you guys, that, have kind of a full W-2 gig and maybe they've got shares or they're exercising shares, or they work for a tech company, or they're looking to exit. I mean, again, the state you live in, the businesses you invest in, right? Like the whole tax picture of what happens at an exit event is extremely important. And even if you're planning on not having an exit event, I mean, we've got clients that are like, hey, I'm building this so that my 22-year-old, who's property managing can really run this. And like, this is kind of like a retirement check, but it's also a bigger kind of family plan.
Yeah.
Even with that, right, there's things that we're going to want to make sure we're doing, building up cash. And then like to the last point, right, have a plan, consider bonus depreciation. And the last point is treasury management. So a good business is a cash flowing business.
Yep.
So even for businesses where we're making big investment, it's invested with the expectation that there's going to be a return. There's got to be cash flow. Managing cash, I think, is the single most important skill that I think business owners are lacking today. It's not tax. I think, tax you can kind of get by understanding net income and a few basic principles and what bonus is. But I think treasury management, making sure you're getting a yield, percentage yield on cash that's just sitting, knowing like not to put business cash into a volatile index that might lose money. I'm not saying, hey, put your money in crypto because it's always going to rise, because obviously we've seen where that's depleted completely. So being safe about how much cash you allocate, and hey, this is my operating account, I'm going to move cash here. This is my tax savings account and put cash here. And this is my war chest where I'm just going to, accrue 5% on a 2-month CD or something like that is really important. So if you're not cash managing, I would say start by looking at CDs, start by looking at low interest yielding accounts, low to high. I mean, low is relative right now, but I think that's a really important skill that I really want to see our clients and like this generation of kind of business operators to get better at. Because we're not used to thinking. I just got back from Buenos Aires 2 weeks ago, on a talent tour as we're expanding the team. Even your fixed income 70-year-old, grandpa with a, ninth grade education understands yield because they have 8 to 15% inflation on a monthly basis. So I think we have something to learn from that. Essentially, like I don't want the economy to end up like Argentina's, but financial education comes from a place of need, and I think today where our businesses need to focus is on cash management.
Yeah, I think that's very important. That's a very good closing thoughts. All right, guys. So we're gonna go into our Q&A. I'm gonna go ahead and leave this here. This should be one of our courses. If you guys do want to go ahead and take a look at it, it's our Tax Sense course. It's largely geared towards our real estate clients, Airbnb. For you guys that are in the car share industry, rest assured, we're working on it. We're gonna get one rolled out for you guys shortly. But yeah, go ahead and take a look at it. There's still going to be useful information, even if you are in the car share industry, to be quite frank with you, because a lot of the same rules and strategies do apply. So we'll leave that there, but let's go ahead and open it up.
I think I can manage the questions, so feel free to manage the questions. Yeah, I would just say that this course that we've rolled out is really for, like, if you're an existing client, we can give you the kind of overview of topics we've covered and see if it's something that we've already discussed together. But really, it's for the clients that we can't serve, because I think that's a reality of being a services firm is, there's only so many people we can talk to, build a relationship with. So we wanted to create a way to basically give our bottled knowledge to as many, I think, excited short-term rental operators as we could. So we've got this course. So if you have a friend or if you know someone in your community who's saying, hey, like, who do you work with from a tax perspective? Oftentimes, I promise you, what they really need is kind of a crash course in what is depreciation, what is net income, what are the things they need to worry about in the first 1 to 3 years. If you have someone that fits that need, you can email me directly, Miguel at Shared Economy CPA, and ask for a discount code. So I'll offer that if you're on this call. If you're watching a recording of this, I'm not going to honor that. You can certainly email me, but I'm going to check the timestamp. So yeah, no, I really want this to get. I don't think this is supposed to be a significant revenue stream for us.
No.
It's simply us putting it out there, and you're only gonna do it if you pay for it. So I think that's the reality of it. Sorry, where did we left? I went back one step. Where did you want to go forward?
No, we're good. Just you had to drive a message about what the course entails. We're going through Q&As now. So see what some questions have. So
we're gonna do fire rounds. So I'm not gonna think about what the intent of the question is. I'm just gonna hit me with it. Any deductions if I rent out property in Mexico? Let me answer that question. Yes, there are deductions if you're renting out property in Mexico. You can deduct expenses incurred in running that business, including the purchase price, which is depreciated over a different time horizon because it's international property. I have an Airbnb in Rosarito, Mexico, and our family spends all our summers in Mexico City, and we have a team down there too. So know Mexico quite well. You might have Mexico tax implications.
yes,
and that's where we will refer you to someone that does Mexican taxes.
exactly.
But from a U.S. perspective, if you're a U.S. citizen, you file on all your income and expenses. That is the honor and privilege of being an American citizen. You do not report just on U.S. income. Do not follow European tax advisors, by the way, because they're going to tell you to move to Malta. Doesn't change the reality as a U.S. taxpayer. You pay on everything.
Right. Yeah. So exactly. So just kind of piggybacking off that, should that be your situation, your U.S. residents have a property out there, we can certainly help you out on the U.S. side, the advisory side. Just we're gonna have to find another resource for you should you have any liability over in Mexico.
Yeah. What happens if bonus depreciation drives your income to 0 or less? What happens when your income goes to 0 or less? You pay less taxes.
Yep.
Is the short part of it. There's kind of a caveat to this. You might have bonus depreciation and suspend the losses if you're not actively involved in the business operation. So passive losses get suspended and they get accrued as the business makes income. So it's almost like you've got this reserve to not pay taxes later. It's typically how it works. Interesting. Travel expenses, repairs to and from Mexico. I would say put together a P&L, because really it's a macro, not a micro question. It depends what your P&L looks like. Like if you're telling me you have 0 in income and $40,000 in first class flights and research in Cancun. I mean, I've seen it, right? Like,
Yeah.
I don't know. I don't remember the expression, but like, what is it?
It has to be deemed reasonable, right?
Pigs get fed and like hogs get slaughtered or something like that. I don't know. English is my second language, so sometimes. But anyway, point is don't get too aggressive. I mean, I think one of the key components of deductions has to be reasonable.
Yes.
So yeah, I mean, I take out my business card when I buy a flight to I have to fly into Tijuana or San Diego. And then, I have a partner, so it's like I can't expense everything there, but what you can do is you can save your receipts if you're in a partnership, and you can have unreimbursed partner expenses. So a little bit of kind of a pragmatic way to solve for deductions you can't put in the business if you're in a partnership, but you still have it. I do recommend having a separate business card.
Yes.
So that there's no questions about that, because the level of detail that you need. So if you're just getting started, trying to see this, Patty, if you're just getting started, and you don't have a business account and you haven't tracked everything, like you're gonna have to pull everything out in a spreadsheet and then like detail specifically like what that expense was for. And there's nothing that feels worse than having to do that for like 10 $7.99 to $15.99 transactions.
Right.
Not 10, like 100. I mean,
yeah. And how does that change between, that was a good example because I didn't know that about partnerships. How does that affect our single member LLC clients? Similar?
Well, yeah, I think what I shared is more specific to a partnership where you don't want, like, I don't want my partner dumping, like their first class trip to, San Diego.
Sure.
So but they want to deduct it, right? So they've got to do it as a part of their tax return as an unreimbursed. If you have a single member LLC, then just put it on the business card. There isn't necessarily a formal reimbursement process on the tax form for that. But there can be a separate way that you put expenses into that LLC if, say, for example, like we were talking about cash management, like if you're really focused about keeping that P&L just operational expenses, you can do something where you write an invoice to the LLC for your travel.
Sure.
And the LLC pays you. So it's almost like you're taking a taxable and then it shows up on the company's P&L. You just got to make sure I just struggle sometimes sharing this because there needs to be a certain paper trail that I would say if you're doing it on your own, I would have that Excel list with every transaction specifics by each one. And if you've got, a bookkeeper, you can kind of walk them through what you're doing and they can create a reimbursement invoice.
Gotcha.
Yeah. What if I paid, I skipped one. So home office deduction is simple method always better than the regular method? Or does it depend case by case? I always, I say this a lot to my kids that like anytime we use always or never, we're always wrong.
Yeah.
So yeah, I mean, it definitely depends. I think if you've got a lot, very rarely, I think is the square footage way going to be more effective if you don't have cheap rent. If you have a mortgage, you have interest and you're allocating it. It's just going to be a higher deduction, but it's more complex. I think oftentimes, who take the standard is, like if they've got a freelance business, is like people who are really wealthy will just say, hey, just give me the square footage. Like, I don't even want the risk of having to break this out later. I don't want anyone looking at my mortgage statements.
Right.
Like the swing isn't big enough. So it depends in there, but typically breaking it out is going to give you a higher deduction.
Interesting.
Do you want to read the next one? So I can.
Is it in the chat?
Yeah, you can just read off mine.
Gotcha. All right. What if I paid cash to clean gardens and they don't want 1099s? Gotta issue them 1099s. It's a driving message there. Same rules apply, right? If you paid them over $600, you want to make sure that you're doing your due diligence. So you're gonna have to issue them 1099s. It is what it is, unless you want to do it under the table. Why don't you give them a little more insight? You might be a little bit more.
If you do it under the table, it's not on the table, so it's not a deduction.
Yeah.
Like it's just simple. Like you can pay them cash and not report it, just don't deduct it.
Yeah.
Or deduct it and just know that, the IRS is gonna say, hey, you've got X amount a contractor spend is a specific line on the Schedule C or, it's a specific line on any tax form. So if you've got a number there and no 1099 associated with your EIN, it's just risk.
So would you say driving message, you should 1099 them? Or, in this specific case, they don't want a 1099, what would Miguel do?
I would change contractors and let them know that it's a requirement. Oftentimes the immigrant community, being from, I'm a child of two immigrants, the immigrant community understands this. And for that reason, they have tax ITINs. They're very common. And yeah, there's a price for under the table and there's a price for, okay, you're going to 1099 me. The only difference with the price where you're not going to get 1099 is that the risk is on you. It's not on them.
Yep.
So the risk is on you if you get audited, which I think is going to the highest audit class, by the way, guys, I'm sorry, are small businesses.
Yep.
Are the businesses that can't afford representation. This is easy pickings for the IRS. And I always say, like, hey, if we're going to sit together, if I'm going to fly out to Florida or Dallas where you guys are at, for the day to meet with an IRS agent, because typically they build everything up. They want to meet face to face. It's the IRS's thing. It's like get in front of taxpayers. They think like they're doing a better job if they're incompetent in person. I'm sorry. I'm so sorry. Let's cut that out in the recording. We want to be able to say, hey, we did all the obvious stuff right. So I would say do the obvious stuff right. Do the things in gray. and basically play where the gray is what we say here. So, if you're gonna push something, I mean, do it because of our interpretation of the tax code and existing documentation, not just because, oh man, they said they didn't want to take 1099.
Yeah, very good one. All right, let's see. We have roughly 5 more minutes. So let's see. Do owner drawing are taxable in-person tax return if owner? I cannot understand this question. Sorry about
I
that.
don't either.
Okay.
Yeah, if we were reading your question about drawing taxable personal tax return, if you can just restate that, we can try that again. If I'm not a real estate professional, am I capped in terms of max depreciation in the first 5 years? I receive a cost. I don't really know what the question is, but I think there's a few things that you're kind of highlighting here, Gabriel. I think one of them is that you're limited in terms of what you can lose, and including your AGI. So the rule is, hey, if you're an active real estate professional, you can take losses against your W-2 income, right? That's where you get. There's an exception to that. It's in publication 469. I think we've done an entire webinar on it, but you can take a passive loss and take it active if your average rental stay is 7 or days less. So we do an analysis to validate that when we take on a client. Yeah, I would confer with the tax professional to see if you can get that exemption, because then the answer is no. There's no limit to the amount of losses, and a cost seg study is just going to lever that loss.
Yeah. Also, hey Gabriel, how are you?
Hey Gabriel. I'm gonna go to someone we haven't heard from yet. Sorry, it's just if I see a lot of numbers or like two block, we just don't have time. But you guys can email me, miguel@sharedeconomycpa.com. There's a risk I might not get back to you right away, but I will try to respond to all the emails. Let's see here. At what age can you start paying your children? You can be any age to pay your children.
So can they be 6 months old? No.
Yeah. Do I need an S corp or LLC for that? So this is a good one. So paying your kids, I think we see that strategy quite a bit. I think it's more of like good hygiene versus a big tax refund driver or tax liability killer. It's more so like, I think the value, we've talked about it, like the value is actually getting your kids to work.
Exactly.
And that you're giving them a little bit of money. So the strategy that I like is taking whatever you would pay them and just putting it straight in their Roth. Because you can put up to the standard deductions and have to report, and they've got money that they can take out later. So
Interesting.
with a Roth, right, you're using post-tax money. You're not getting the deduction on the Roth contribution, but they can take that money out whenever they want tax-free, and it grows, right? So for like my kids, I'm more interested in the money that they'll have in 10 to 15 to 20 years. Traditionally, I think the thinking was everyone goes to college. I have a kid going to college, so I'm part of that, but I would rather have money that's available if they decide to go to a coding boot camp for 6 months and then make 100,000. I mean, I would take that deal. And then they would have like a nice little investing nest egg. So yeah, you can pay kids young, but they've got to actually be able to do something. And I think like showing up in your marketing materials as a kid actor is actually just fine. So that's a way to include a 6-month-old.
Yeah. Okay.
It just needs to be legit. Like, you can't have done it once and like not put it on your listing, or like you got to show me like a website or something to like really substantiate that. Because again, if I'm sitting with you and an IRS agent, I don't want to get cute here that they got paid $50,000 for you putting something on your, like digital camera that you got from college.
Right.
Like, come on, you've got to do something with it.
Gotcha.
All right, so let's try and get one more. And not more than anyone else. Last one, how do you feel about Schedule C active for W-2 worker that did more than 100 hours and not more than anyone else? You got to do more than someone else. You got to do more than everyone else. It's taxable personal return. If the owner withdraws money from a C corp, is it taxable on the personal tax return of the owner? Some things depend. If the personal owner has a positive equity balance, or a loan to shareholder, rather. So they've put up money in cash that fund the C Corp and they take that down. That could be a drawdown of the loan to shareholder. That's not official advice. That's just a possibility in which it's not taxable. Otherwise, take money out of a C Corp. You can't take a personal draw. That doesn't make any sense. It's literally not part of the rules of a C Corp. The rules of a C Corp is you got to dividend it out, which is taxable, or you got to pay it as a salary. So, yeah, if this is a situation where the owner's trying to withdraw, and doesn't like the double taxation from a dividend, then you should probably look at an S Corp or an LLC. But again, I mean, there's probably bigger conversations there.
Yep.
Well, cool. I think we'll wrap it there. Love the Q&A. Thanks, everybody.
Yeah, thank you guys so much. And yeah, look forward to doing the next one. I think we have one already scheduled for next month, right? Maybe the month after that.
I don't know these things.
Tax season's upon us, guys. So give us grace. I think, once again, we'll come out with a schedule. We're going to try to do these a lot more consistently now. So yeah, just look forward to getting that communication. Happy tax season to all of you guys. Reach out to myself if you're not a client, you need any assistance. My email is going to be Jacob@Shared Economy Tax. I think it should be not there, right over here. Right here. So I'll just leave this here for a couple minutes, then I'll end the meeting. But yeah, feel free to reach out, either give us a call. You'll have better luck giving me an email. And yeah, happy tax season to all of you guys.
Or spring break.
And I will go ahead and end it. Get your last screenshots in there. And been a pleasure, guys. Thank you so much.